Welcome to the Next Dollar, your trusted source for daily gold market insight and strategy. I'm your host, bringing you a complete midweek breakdown of gold's price action, technical setups, and the trading psychology you need to stay ahead. As we move into Wednesday's session, the market is showing classic consolidation behavior. Tight ranges, moderate momentum, and traders waiting for confirmation before taking their next big step. In the next 20 minutes, we'll analyze gold's key levels, explore what smart money is watching, review technical indicators like RSI, MACD, and ADX, and build clear strategies for both bullish and bearish scenarios. Let's dive straight into the charts. Gold is currently trading between $4,000 and $4,200 per ounce, a range that has defined the past several sessions. This zone reflects a balance between buying support and profit-taking resistance. On the daily chart, price action has been coiling tightly, suggesting an upcoming breakout. The US dollar has stabilized. Treasury yields have flattened and global risk sentiment remains uncertain, all of which keep gold in a wait-and-see mode. Technically, momentum indicators show neither side dominating yet. This means Wednesday could become a decision point, a breakout to the upside if momentum expands, or a bearish slip if support fails. Let's begin with the support zone, the heart of the bull's defense. Between $4,000 and $4,050, gold has found repeated buying interest. Every dip into this zone has attracted buyers, indicating strong psychological and technical support. If you're planning to trade long, this is the level to watch. When price touches this area, confirm with candle reversal signals, bullish engulfing, pin bars, or strong volume spikes. A bounce from $4,020 or $4,030 can open a buying opportunity toward the mid-range resistance around $4,133 or higher. But remember, your stop loss must be tight. Place it below $39.80 or $39.90 to protect capital. Support only matters as long as it holds. Once it breaks, the narrative changes completely. Now, let's flip to resistance. The zone between $4,133 and $4,200 has acted as a ceiling for weeks. Each time gold approached this level, sellers stepped in, taking profits or opening short positions. To confirm a breakout, you want to see a decisive close above $4,150 on at least a 4-hour candle, ideally accompanied by a surge in volume. If that happens, momentum could carry gold toward $4,250 or even $4,300 as traders chase the breakout. For momentum traders, this is the excitement zone. Just be sure to wait for confirmation. False breakouts around major resistance are common traps. Now we have to address the risk scenario. If gold fails to hold above the $4,000 mark and we see a clean break below, bearish momentum could accelerate quickly. This would open the door for short sellers aiming for targets near $3,950 or even $3,900. The logic is simple. When a psychological level like $4,000 collapses, stop orders trigger, liquidity flushes, and volatility spikes. If you plan to short, wait for confirmation, such as a 4-hour close under $4,000 followed by a weak retest. Your stop should sit just above $4,050. Remember, in fast-moving breakdowns, risk management matters more than prediction. Midweek sessions, especially Wednesday, often bring volatility. That's when new economic data releases hit, the dollar index shifts, and traders reposition. Gold right now is at a decision zone. Either it confirms the range and continues sideways, or it explodes out of it. For short-term traders, you can mark the zone. Support, $4,050. Resistance, $4,150, $4,200. Trading inside this range means small profits and quick exits. Trading outside means potential momentum plays. Don't try to predict which way it will go. Wait for the market to declare its choice. Let's move to the indicators. Starting with RSI, the relative strength index is hovering near 52, which is neutral. That means neither overbought nor oversold conditions. MACD shows the histogram flattening and the moving averages are converging. Again, a signal of balance waiting for momentum. ADX, the average directional index, sits around 21 or 22, which indicates a weak trend. So the story across all technical tools is the same. The market is coiling, compressing, and preparing for expansion. When all three indicators are neutral, traders should focus more on price action and volume than on lagging signals. Institutional traders, the so-called smart money, are closely watching the range between €4,033 and $4,200. That's where liquidity pools build up, large pending orders, stop hunts, and breakout traps. Professional traders often wait for a confirmed close outside this range before committing heavy positions. If price breaks above $4,200 with strong volume, they'll ride the wave higher. If price rejects that zone and falls back under $4,100, they'll flip short quickly. For retail traders, the best strategy is to mirror this behavior. Don't jump in early. Let the whales make the first move. Follow once direction is clear. Now, a quick reminder on trading psychology. The biggest edge you can have this week is emotional control. Don't predict, react. The best traders don't guess the top or bottom. They wait for the market to show its hand and then execute with discipline. If you missed the first 1% of a move, it's fine. Confirmation matters more than ego. Your goal is consistency, not perfection. Let's touch on fundamentals. The U.S. Federal Reserve remains the primary catalyst for gold movement. Any speech, data point, or statement hinting at rate changes directly affects gold because of its inverse correlation with the dollar. If the dollar strengthens, gold typically pulls back. If the dollar weakens, gold gains momentum. This week, keep an eye on CPI, PPI, and any Fed commentary. Those are the hidden drivers behind every candle you see. Before we wrap up, let's quickly recap the technical map for Wednesday. Support zone, $4,000 to $4,050. Mid-range pivot, $4,133. Resistance zone, $4,150 to $4,200. Upside targets, $4,150. Then $4,300 if breakout confirms downside. Target, $3,950 if $4,000 fails. Terror. These 5 levels visible on your chart throughout the session. Even with all the excitement, gold remains technically in consolidation. It's neither bullish nor bearish until the breakout or breakdown confirms. This environment rewards patience. Quick scalps, small profits, and reactive trades outperform wild predictions. Consolidation phases build energy. When the release comes, it's usually powerful. To sum it all up, gold is in a neutral to mildly bullish bias heading into Wednesday. Support near $4,000 is solid for now. Resistance near $4,200 remains the wall to beat. Momentum is light, Volatility is sleeping, but both can wake up in a flash once the breakout hits. So as you plan your trades, remember, follow structure, not emotion. Respect your stops. Let confirmation guide your entries. Thanks for tuning in to The Next Dollar, your daily insight into gold, the dollar, and the global markets. Stay informed, stay patient, and trade safe. To wrap it up, the overall bias remains neutral to mildly bullish. Gold needs volume and breakout confirmation to run higher. Stay sharp, trade safe, and follow the levels.